Okay, good morning, everyone. Today is February 22nd. Sound check, sound check. If you can just type in the message so I know that everything is good. And we are ready to present the current situation with the market that is moving quite fast today. My name is Josip Kasik, and if you need to contact me, feel free to do that at tradeactive.com. We're gonna go over what the market is currently doing, starting with the SPY. So SPY currently is having the second day down, when in fact the standard deviation points out that this could happen more than 3 days in a row. So we are now looking here, and we are concluding that according to the standard deviation, this can carry on for more than that. So I'm going to also pull up the four charts that I usually look at and evaluate how is that looking versus on the diamonds, versus on the QQQ, and also on the IWM. So I'm enlarging the monthly chart of the Dow Jones that tracks the uh, blue chip stocks, and as you can see over here, we have a bar for February that is currently being formed, and right here we have a line that represents the low of the January. So we're completely encapsulated within the previous bar, and the month is not yet even over. This blue line that you're seeing here, that was representing the low of the December that we pierced to the downside. So overall, the way how the situation looks like, we are now within the range of the January. If I now move on to the QQQ, you're going to see on the QQQ situation is a little bit similar in the way that the bar is big in relationship to what it was on the Dow Jones Industrial Average. And this particular bar that is now being formed is very, very close to challenge the actual low of the January, which means the technology sector has a lot more room to go down, and this might be actually a concern for us. So when I remove this line and just kind of point out this line right here, if this gets violated to the downside, we can go lower. So I'm already thinking, if I'm going to pick the bearish candidate or the bullish candidate between these two, obviously the one that looks weaker is not the Dow Jones, but the QQQ. I'm going to quickly glance again at the SPY and conclude it doesn't look that different from what the Dow Jones is, but IWM is one that I want to now evaluate, just to see if IWM that tracks the Russell 2000 gives me a more trading opportunity or not. In fact, it looks that in the relationship to the other one, it's not as weak as the NASDAQ. So obviously for me, the best choice to trade this morning would be on the QQQ. So I'm gonna kind of share with you what I have in mind in the terms of what I'm gonna do this morning. So I'm planning to actually place the trade on the QQQ, and it's gonna be a bearish trade. And this bearish trade that I'm gonna do, it's gonna be a bear call spread. Bear call spread that I will try to use the credit. I'm going to use the credit to finance. So bear call spread is a credit trade that is going to use that money to finance another bear put spread. Now this bear put spread is really a trade that is a debit trade. So in a moment when I pull up the option chain, we're going to work through these strike prices to determine the trade that is most suitable for us. So starting with the expiration date, we are selecting today's date, which is February 22nd. We're going to be looking at out the money and out of the money, which means that we are currently sitting here at the 339. So what I'm going to do, I'm going to actually type the plan of the attack that is going to take place on this particular product this morning, which means if I'm considering the both sides, so I have a call side and I also have a put side. So on the call side, I'm doing the bear call spread. On the put side, I'm doing the bear put spread. So one is a debit, one is a credit. So this is a call side. We're going to do out of the money bear call. And over here, we're going to do the out the money bear put. Okay. And here are the strike prices that we're going to go over it. So these strike prices that we're going to go over it are going to also reflect on the put side. So the trade I'm going to be placing, I'm going to be also placing it in the paper trading account. And when I go into my paper trading account, I'm going to be changing the color into white, because usually that's what I like to do to make sure that I don't mix up the account between the live account and the paper trading account. And we are going to then go ahead and select strike prices that we need to do to receive some credit that we're going to instantly turn around and utilize for paying the debit spread. So basically, my credit spread is going to be partially paying for my debit spread. So I go over here where it says the QQQ. I pull up the current price, which is currently sitting at the 338.80. 338.80 is the current price. So if I know that we are currently sitting at the 333.80 and there was some change like that, I want to make sure that I'm selecting the strike prices that are right above. And one of the easiest way to do this is to actually place the trade and then to talk through that trade, what is really happening. So 339 would be out of the money, 340 would be also out of the money. So if I now go ahead and sell this in a live market, I'm getting about the 49 cents. At the same time, I'm going to ask for a 50 cents. I'm going to make sure that I drop this down only to a single contract. So what I'm doing right now, I'm clicking this to go down to the single contract. I'm asking for 50 cents. And if I get filled for 50 cents, in fact, they gave me the 55 cents. Now what I can do, I can actually purchase this 339 and sell the one that is lower. So this is now slightly at the money by 9 cents. So I'm going now buying and now selling the lower one. So 339 is at the money, 338 is out of the money. I'm going to reduce this to single contract. So here's a single contract and it's only 47 cents. And I was able to get that at 47 cents. So we've been in this session only a few minutes and I already have placed these two trades. Now for the rest of the session, I'm going to actually slow down and explain what really took place, walking through and just kind of nailing down the explanation what happened. So execution really takes only a few seconds, but what we have done needs to be now explained in order that whoever is watching this can actually replicate this. So when I highlight this strike price that is current, that means that QQQ at the time of my entry, when I went ahead and sold to open. I sold to open this 339 call that at the time was out of the money by 20 cents. And I'm saying by 20 cents for a simple reason, because the price was sitting at 338.80. I was then naked a call. Now, naked a call is never a good thing, because in order for me to have something, I would need to be covered. So I was actually covered by buying to open this higher one, which is a 340. And as you can see over here, I'm circling this 340 because this is a call that I went ahead and I purchased, and I made sure that I purchased it only one time, and I purchased it for $1.28. And then I turn around, and I'm going to just change this color quickly here to, let's say, blue, because that's kind of easy to understand. That's the buying part. So I went ahead, and for 183 I was getting the credit, and I ended up returning some of this 183 by buying the 128. So at the end, net, I'm actually up 55 cents. Now, having said that, be aware of it that I turned around, took that 55 cents and reinvested down here, buying this for 47 cents. So let me now just run out of this, in the pieces. So you will know that this is now 2 times out of the money, because it's even further out, right? So this 340 from the current price is out of the money in amount of $1.20, while 339, you can't say it's really at the money, because it's still out of the money. If I had entertained the possibility of the 338 on a call side, then on a call side, obviously that would be at the money, in which amount? In exactly 80 cents. So when I was learning this, what the market maker pointed out to me, who was teaching me, is that you actually just need to be aware of it. Back then, the increments didn't go into 50 cents, they were going in dollar increments. If something is less than $1, then most likely that is at the money. Now, of course, now with us having the 50 cents increment, that's really not necessarily true. But when I was learning this back in the days, 2002, 2003, this is the situation. So this is the one that I skip. I did not trade this one. I'm going to delete it. I just used that to explain it. So this is the one that I need to be concerned about, because the selling of the call gives me the obligation to sell. But because I have obligation to sell, I went ahead and I bought the call. I bought the call that was 2 steps out of the money. I paid for it $1.28, and because it gave me a right, I was able to sell this 339 call that was really only 20 cents away from the current price, and I returned some of this 128, and I don't need to do the math because a 55 cents credit has come to me. So this bear call spread has provided me a credit of 55 cents, or the $55. I instantly have turned around and invested that into at the money bear put, which is nothing else but the debit trade. And as you can see over here on the debit side, I'm going to just make sure that I have this circled in blue, I actually gave 47 cents out of this 55 cents. So how much money do I have invested in this thing right now? The amount of money that I have invested in this thing is only about $100. And why do I say $100? Simply because it's only the call side on my leg that is credit is that matters, right? So this credit is 100, because the distance between the 340 and 339 is a 100, right? So what I'm doing right now, I'm now walking through the explanation, what I did in that little snippet of the few seconds of the execution, so you will kind of follow it. So if I'm now looking at the money, and I'm looking at the strike price that is 339, and you would notice that this one right here that is at the money is a put. It's not a call, it's a put. And moreover, that put is bought. So every time when we buy the put, we have a right to sell at 339. So right to sell at 339. So I want this put to increase in value. Okay, I want this put to increase in value. I want this price to go even lower than a current price of the 338.80, right? And I have purchased that put. So I bought to open, okay, long, right? That at the money 339 put. Now, if I bring up over here again the option chain, you will notice that I have something here that is called intrinsic value. I'm going to again circle that right here so it can be visual. And you will see it. Here's the intrinsic value. It's at 0, while the other one that I purchased is right now, because the price is dancing, it's actually going my way. Initially, this was at 338.80, and now we're at 338.69. This thing is going my direction. The prices of these premiums are changing. So I went ahead and I sold this out of the money 340 put. Now, be aware of it, this is a put side, so everything is now flipped from what is here. So if this is now out of the money, and then this right now over here is out of the money, so what am I really trading? I'm trading the options that in the future I would like to see this becomes in the money and this becomes out the money. But I will now talk about the worst possible scenario, what it could happen to me in this particular situation, and that's why I want to actually bring in the top, and I will now work first on the bearish side to explain what the bear call spread in this situation is. I'm editing this spread simply because I know the prices of what I got filled on each of these contracts. So on my contract for the call, I have paid 128 for my 340 and 183 for a 339. So when I go over here where it says the mid, I have ability to actually change to what I got filled, right? So I'm going to make sure over here that I'm in the right cycle, and the cycle that I'm trading is at today's expiry. The moment I change one, both of them change, right? So I sold 339 call, and that 339 call I was filled for $1.83. The bought call I filled for the $1.28. So when I click now OK, this thing populates right here, and I'm going to just take this snapshot quickly so I can have that side by side in the document, and then later on I can actually post this and have that presented in Trading with the UFOs website. So I'm now working piece by piece, explaining everything that has gone through, right? So this is my bear call side. So I sold to open 339 call. I got filled at 183. That's the sold one in the real time. I did the 340. It was a 128, and I got filled at 50 cents. So now let's go back to the page and click simply risk graph. Now this risk graph that I'm showing is just for one contract only, and this is a one contract of what I have traded today. So right here, as you can see, this is my profit potential, and this is right now my loss. So if I want to explain this even further, I can actually start with the maximum loss is nothing else but the difference of the $1. And where did I get the $1? That's the difference between the 340 and 339 minus the credit received, and the credit that I received was the 55 cents. Therefore, I can lose less than I'm what actually uh, making. So over here it says 45 cents or the $45 is what I can lose because really I got paid 55. That's for the bear call spread. So this is now for the bear call spread maximum loss. I'm going to move on now and explain what is the situation with the put side and with my bear put. Now I want to say the bear put is almost like a double bearish, right? So it's like somebody from England who speaks English. So that's not Australian, that's not Canadian English, that's not American English, that's like a British who really speaks English. While over here I have a call, but it's a bear call, like I pointed out to you before. That's somebody from Austria who speaks German, but it doesn't necessarily is German, he just speaks German, right? Or a French Canadian, don't call them French, they are Quebecois, they are very nationalistically oriented. So I'm going to now work on the bear put spread and just kind of slowly explain what we did on the bear put spread. So I'm going to again alter this whole spread by not looking for a bear call, but looking for a put side. So I'm changing this to put and to put. Now I also want to point out to you, if I have changed this to the puts and puts, what happened with the sign? 339 on the put side was bought, while the 339 on a call side was sold. So I want to make sure that you're aware of it, that you can't leave this the same way, otherwise it turn out to be a bull put. And in this case, I'm actually changing over here so you can be aware of it, that this is the one that I bought and this is the one that I sold. So one more time, not losing anybody, but pointing out to you that just like I have here on my 339 call, a purchase, and I'm going to now change the color into red here, that 339 put is actually flip side of it. It's being bought. It's being bought. Okay. Now the 338 is what is the difference. 338 is what is the difference. Okay. So I'm gonna go over here and make sure that you are seeing that this is being bought and what is being sold is a 338. So this is a 338. So let me make sure that I have this now in my notes that I'm going to post later on clear. So we actually went ahead. I'm going to cut this. I'm going to put it down here. And I'm going to make sure that this is clear. This is 338. It's not 340. So this is a double negative. And what do I mean by double negative? Well, I need to spell this thing out so it's clear that when we sell a put, okay, so now I'm talking about, I'm going to draw the line like this here. So it's clear that we are now switching from a bear call side to the bull put side. And this bear put, right, is dealing with the puts. And the puts are composed of selling to open a put. Now, every time we sell to open a put, this is what I like to call double negative. And this double negative means that we're really bullish. But bullish with the obligation to buy. Okay, so our obligation to buy, it's at the 338, and this is exactly what we did right here. So 338. So just like I have created over here a little snapshot from the top, I'm gonna create a similar snapshot of the bear put, and I'm going to combine it together and explain to you what is the maximum that we can get. So I have gotten filled on the bear put side in amount of $1.94 for the one that I bought. So $1.94 for the one that I bought. And when I go and edit this, I'm going to edit what did I got filled. I got filled for $1.47. So one more time, I'm selling the lower one, which is a 338. I'm buying the higher one, which is a 339. And I'm getting here, as you can see, let me just take a snapshot of this. Debit, bear put, debit of 47 cents. So when I insert this here in the document, it's going to be more visual and more clear what we're doing. So I'm separating here with this line the bear put from the bear call, and this is a debit trade in amount of 47 cents. So just like I have here, what is my maximum loss? I need to figure out what is the maximum loss right here. Well, I don't, because it's a debit and it's already spelled out that the most that I can lose on it is my debit. So the most that I can lose is 47 cents. So you're like, well, wait, but then you get paid for that? Yeah, I got paid $55, and I have invested out of that $55, $47 right here. So I'm actually ahead, and there's enough money now for me to even to cover those commissions. Because when I had placed these trades in accounts, so I'm going to go under the monitor tab, I'm going to go account statements, I'm going to show that I have here cash that was open up here and that it charged a commission of 65 cents twice. That's the $1.30, and then 3 cents in the miscellaneous fees that are exchange fees. And I have done this for the put side, and I have done this for a call side. So really, in this particular case, I do have in this trade $100. Okay. Now, what is going to happen at the end of the day? Well, the result is going to be clear right here with the P&L, whether or not I'm up or I'm down. Now, when the market is open, then this P&L is not the place that you should be looking at, because it's fluctuating all the time and you might be too worried. But in reality over here, you have all the Greeks presented: delta, gamma, theta, vega. So if you switch back to the trades, you're going to see my bear call spread is doing fine, because if the time comes to the expiration, all this $1.86 and this $1.36 are going to become 0, 0, which means this 55 cents that I have received as a credit is mine to keep. So therefore you can say like, well, bear call spread worked out for you because price is below your obligation to sell, which is a 337, and you had made that 55 cents. Well, yeah, I did, but I instantly have turned around and invested in bear put spread, which is now directional trade. So if you can just kind of be aware of it, that the conclusion of what I'm trying to teach here, this is my conclusion. So conclusion is that bear call is, in this particular case, non-directional trade, while my bear put is slightly directional. And I would specify up to 338, because if this goes any lower than 338, it doesn't matter for me, because the most that I can make is, and this is what I'm going to calculate, if I know what my maximum loss is, I also need to know what is my maximum profit. And just like over here, we had the dollar, and that dollar comes from the distance between the 339 and 338. Most that I could make is 53 cents. So when we subtract from a dollar, my profit is, at the end of the day, 53 cents. But that 53 cents was actually paid for and financed with this 55 cents. So it's as close as you can get to free trade if the price goes down. But if the price goes up, then what can I lose? I can lose this $47, right? I can lose that. depending where the price is closing. So let's revisit this one more time. So I'm copying this into the risk graph, and you would notice in the risk graph we have now price action showing where my profit is. So on the put side, price would need to go down, 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 down to 38, and this is where I get maxed out on my profit potentiality. At my profit potentiality, right here at this level is where I make the most. Right here, at this level, when I make most. At this level right here is where the leg is broken because I can't lose any more than the unit that I actually own. And the unit that I own is the one that is on the put side, 339. So 339 is my right to sell. 338, as I have pointed out to you, that's a double negative. It's an obligation to buy. So whether this thing goes down even lower than the 338, it does not matter, because the most that I could make is a 338. That's most that I can make. So how do we arrive at this particular trade at this particular point in time? We have arrived to this particular trade by first starting with the big picture. And what do we do on the big picture? On the big picture, we actually have opened up the monthly, and we have looked at how the monthly is looking. Now I'm going to open up the daily, and I'm going to now look at exactly at the trade that I have on. It's on a QQQ, so I'm going to just change this into the QQQ so you would see that the QQQ as of this morning had been up, but a selling pressure has arrived and it has pushed the trade all the way down virtually to the low. Now there's many different ways how you can actually look at these things, right? You can look at them at the different websites, and you can decide whether or not this is really a good way to look at it. One of the favorite websites that I like to go to observe what is going on is actually Finviz. So I'm sharing right now with you the Finviz page, and you can see on the Finviz that we at one point were running up, and then the selling pressure came in, pushed it all the way to the low of the day. Same thing with the Nasdaq, same thing with the S&P. But now we're going into the noon session, and this noon session is supposed to be just a bunch of chop, and then there might be some excitement at the end of the day in terms of what is going on. But here under the hood, as you can see over here, it's really a mixed bag, really a mixed bag. So if you have any question, feel free to put it in the chat box, and I'm gonna answer them. Otherwise, I'm gonna just reconclude one more time from the beginning to the end how we arrive at this session. So we have arrived at this session simply by looking at the big picture. And this big picture has pointed out to you that the weakest of the 4 ETFs, exchange traded fund, was not the Dow Jones, was not the IWM, was not the SPY, but it was actually QQQ. So the QQQ was the weakest of the 4 ETFs, right? So when we looked at the QQQ at the time, it was trading at $38, $338.80. This 338.80 is where the price was. So if I now bring back over here, now it just went back by the 3 cents, but that's not the end of the day. That is just an intraday fluctuation. What we decided to do, we decided to place the bear call spread, which is a credit trade, and we use that credit so to finance the bear put spread, which is basically a double bearish trade, because in reality this is a real bearish trade, right? So we're buying the put that are at the money, and we're selling a put that are out of the money. Okay, so what we did in the moment, we went ahead and we placed this trade in, and they were done within a seconds from each other. So when you look at right here, I'm going to open this up, maybe even take a picture here so you would see that executing this trade really doesn't take that long. Execution of the trade, it takes less time than actually explaining it. So in this session, what I have done, I have spent most of the time explaining what I did in, what would that be, in less than 2 minutes. So first I have received the credit of the 55 cents. Then the next minute, I right away went ahead and spent that 40 cents out of that 55 cents. And what the end result needs to happen is that price needs to close below the 338. If the price closes below the 338, okay, so I'm gonna recap all these things, and I'm gonna now assume that it's expiration. So I'm gonna recap this right here, and I'm gonna say today after the market closes, and I'm kind of cheating here. I'm just dumping this in so you would see. Let's say the price is still at the 338. Let's say the price is actually at 338 even. 338 even. If I go with every one of these and I evaluate, I can just say if the price is at 338, then my bear call is dead. So if my bear call has expired worthless, right, I keep the 55 cents. That's good. So having said that, I'm now moving on and explaining what is happening with the bear put side. So originally my 339 was at the money, but if you're at 338, then I can say that is still in the money by one whole point. What happened with 338? Well, the 338 is really, if we are at 338, it's really worth zero, because it would need to be at a different price. It would be at the 338 and a penny in order to be different. So in this case, you can say like, oh, bear put has earned $1. Well, we can't really say that it has earned $1 because out of that $1, did we not pay already 47 cents for it? So in that case, we made 53 cents in profit. So this kind of trade is very, very good for a beginner trader to place, but only with the one single contract and maybe 10 times in a row. After the 10 times, what the trader can do, it can evaluate out of these 10 trades how many were winners and how many were losers. Out of the losers, we need to look at it. What is my average loss? What is my average win? And then you would know if you have a 7 winners and a 3 losers or whatever the thing is. When you are comfortable understanding that you are using, and this is a punchline of my whole thesis, that we are using the credit to finance the debit, then you might promote yourself to the higher one, which would be 2 contracts, and you do that for about maybe 10 times. So now you have an additional 10 trades that you can evaluate. On the first batch, you had like 7 winners, 3 losers. How much were the losers? Like, well, let's say on my losing side, I lose $55. Well, if I lose the $55, it's not just $55. The price would need to now also be evaluated. What if the price closes at 340? Well, that would be then losing scenario, right? Losing scenario. So why do we now, just like we did here today, after the market closes at 338, we come up if the market closes at 340. So I'm going to give the scenario of that because that is a losing scenario. So I'm going to go through all of these things and explain to you what is going to happen on these things if we are closing at losing end. What if the price closes at 340? Well, that's mean in that case we are losing. How much are we losing? Well, that's why I'm calculating this in this last few minutes of the session so I can explain it. So if we are at the 340, then my 340 is still out of the money, but my 339 would be $1 in the money. So then we lost $1. Okay, so we lost $1. Okay, never mind that out of that $1 they actually gave us 45 cents. So you can say like, okay, in that case you lost 45 cents, right? Because that 55 cents was never yours to begin with. On this side, all of this is now, we wanted to go where? Down, and it actually went up. So we didn't earn anything. We lost our investment, and our investment was what? 47 cents. So this one that we bought to open is now completely out of the money. And this is also out of the money. So we wanted the bear put spread to go down. The price has gone up. So we lost 47. We lost over 45. So the loss is within the manageable kind of thing. So having said this, I'm gonna go over this question here and see if there's any question. And if there's no any question, I'm gonna simply end the stream, and I will be posting these notes in Trade with the UFOs. And I wish you a good day. Bye.